Hello, traders. This is General Romulus coming to you live from the Forum in ancient Rome. Okay, well, we've had some really wild moves in a couple of areas of the market. A few things that a lot of traders and investors didn't expect. And, well, now that they have happened, let's go take a look at what it is that took place. Caught some traders and investors off guard, and more importantly, dig into what could be coming next. The only important question that anyone should ever be asking themselves about the stock market anyway. So the S&P comes near an all-time high just a few trading days ago. The Dow Jones Industrial Average as well, closing above 50,000 for the first time in all of the galactic human history. That was quite a situation, quite a mark that was touted, accomplished, or the accomplishment was talked about extensively in a lot of trading rooms and political offices around the country. But what really surprised people this week wasn't so much the Dow, because way back here in November, it's trading at 48,000 and change. And then in the middle of December, late December, 49,000. So with the uptrend intact, not so much of a real jarring surprise. But take a look at this. Financial stocks. It's said that the financial sector is kind of the beating heart of any type of a broader market move, whether that's bull market or bear market. You can kind of think of the financial crisis, although back in the dot-com days, it was certainly the internet stocks that took the market to all-time highs, and then the subsequent crash, the historical crash that followed a couple of years later. But Wall Street being still, metaphorically speaking at least, the center of the financial universe. Companies like JP Morgan and other big banks, Morgan Stanley, Goldman Sachs, Bank of America, these types of companies, critically important to the global financial system. And lo and behold, well, more lo than behold, boy, they really saw a bit of a pullback here recently in the last couple of days. Now they're calling this the AI pain trade. AI is supposed to come in there and disrupt all these industries. A couple of weeks ago, discussion, well, even a few months ago, when it started, discussions about companies, software companies such as Microsoft that are creating a lot of this new AI world that we're going to be living in soon, and perhaps putting themselves at risk, building the very monsters that are going to disrupt their own businesses and risk their own business lines, because they're making products that then make software, and it's a lot cheaper, faster, and easier for anyone to do. And so they're putting, again, a lot of their own business lines and profitability at risk as they develop these products. So the software sector had been getting just absolutely crushed here over the last couple of months. And then it's supposed to come over to the banking sector. Broadly speaking, this is the banking sector, financial sector rather. So you've got big banks, like we said, we talked about. Citibank is in there, JP Morgan is in there, Morgan Stanley is in there. In addition to that, we have insurance companies, not health insurance companies, but property casualty insurance and those types of operators. There are companies operating and working within the financial sector that are not officially in the XLF sector group, but we talk about them as fintech. So that would be kind of a Robinhood type of operator, maybe a PayPal as well, kind of a more recent introduction into the financial landscape in the last 10, 15, or 20 years. And these stocks really got hammered. But to cap it all off, it was companies like this, real estate, financial connected companies, Jones, Lang, LaSalle, CB, Richard Ellis, and a few others. You could see these monster red candles. And this is supposedly due to AI coming in and just wiping out their entire profitability base and taking away their lunch money for, well, perhaps forever. Now, are banks going to soon experience an existential crisis? I had to look that word up. I don't know what it means. I'm ancient Rome, after all. It means it's a risk to your very existence, to your ability to conduct ongoing, well, in humanity case, ongoing life, or in an institution's case, ongoing business. Is this meltdown an existential crisis? Is it going to completely remove these companies from the business landscape starting perhaps in a year or two or three? Or does it change them to such a degree that they simply can't keep up for a long time, and they have to alter what they do, how they do it in manners both far and wide to make up for the profits that the AI pain trade supposedly will be taking away from them? For this, I just like to look at the charts themselves. I really don't know if a year from now, if 5 years from now, if 20 years from now, a company like JP Morgan is going to be operating at its current stuff. I know they're doing a lot of investment into AI, and so are all the bigger companies. They're contacting, the firms like like Microsoft, like Google, and they're getting all of the AI that they can possibly get. They're getting buckets and buckets full of AI. What are they doing with it? Are they going to turn it into efficiency and productivity, which then turns into profitability? Probably in ways, small ways, perhaps larger ways. But for me, that's not really the important part. The important part today is, again, what's coming next? Is there a trading opportunity? Is there investment opportunity? Okay, I'll break that down. For trading purposes, I'm looking at things that will put me into a trade, get me out of a trade within 1 day up to a few weeks, 2, maybe 3 weeks at most. That's kind of a trading, swing trading. I have a reputation out there in the ancient Roman forum. For those who maybe don't know, I do come from ancient Rome. And like I said a minute ago, I have a reputation for being a high quality swing trader. So that again is a period of time that's 1 day up to 2, maybe 3 weeks. And for this to be a swing trade, it's approaching a level that would start to make sense. It has to pull back a little more. I want to see that rubber band get stretched even further. However, for an investment purpose, and that would be anything more than a couple of weeks to several months, perhaps even several years, there's nothing out there. The stocks are still kind of fairly valued. What I look for in a case like this is the entire sector, and then highlighted by some of the individual companies where their ongoing operations are not truly threatened, and we don't know that right now. And they're going to be able to maintain their business profiles. Their dividends, for example, aren't under threat of being cut in the near term, and they still have growth opportunities, that type of a situation. And I don't see that yet. To me, at least, it's not clear. I don't believe that the trading environment that we're seeing in front of us is looking and showing us something that's clear as well. See, if I want to, again, talk about the longer term picture, we're going to change the chart status from daily to weekly. Pretty easy. You just push that button, and then you can do all kinds of things. You can do it 1 second per bar, all the way up to 12 months per bar. Boy, you get a lot of years if you did that one. And I don't see anything right here. This is looking like a bit longer term that it wants to break down and perhaps go down even more to the red line. Oh, I don't know about that. But if we do go back to the daily, again, this looks like it wants to break down. After the pummeling that it's taken in the last couple of days, a bit of a rebound does make sense. But over the next 2, 3, 4, 5, 6 months, I wouldn't be surprised if XLF, if the financial sector is lower than it currently is trading, despite an approaching possible rebound coming in the near term. So if we look at, this is the 200-day moving average. I thought it was interesting. If you go through all 11 sectors, so it's got basic materials, communications, and so on, ending with consumer discretionary. All 11 sectors, only one of them is trading below right now the 200-day moving average. All the others are trading above. And that gives me reason to believe that with the S&P 500 getting hit over the last couple of days and the last few months, unable to break above this upper resistance line. And as for those who have been watching these videos for some time, you know that we drew this upper line a long time ago. This isn't recent, nor is this lower line recent. Okay, when we raised it a bit to just kind of come in line with these last two swing low match points. However, we've had these lines in place for a couple of months. And if you look at the S&P 500, it doesn't look as if it's done going down, perhaps has a little further downside action. Again, this may not be today or Monday. Well, Monday markets are closed because of President's Day. It may not be next week, but over a couple of coming weeks, perhaps even a month or two, we could see some downward moves in the S&P 500 that would add pressure. And more likely than not, the financial sector could be a leader of that downside move. So if you didn't get enough of the banking meltdown and you want to learn more, you can always get a hold of me directly, RomulusTeaches@yahoo.com. Again, RomulusTeaches@yahoo.com. Would be happy to have a longer-term conversation with you at any time as long as it's not when I've got to be fighting in the old arena, because not only am I the founder of the city of Rome, but I also like to keep my gladiator sharp jump in there and test my skills with the top performing gladiatorial athletes of our time. All right, everybody, thank you for joining me. Appreciate that. Again, I am Romulus. I'm heading back to ancient Rome, getting on the chariot. As I mentioned, got some gladiator games to attend to. This time, I'm going to be on the sands themselves. Everybody have a wonderful weekend. I will see you soon. Don't forget, consistent returns regardless of market direction. Bye-bye.